Okay, let's get into Chapter 8, Corporate Formation, Organization, and Liquidation. Let's ask Sam for some focus when we study and for luck on our exam. Let's get into first the transfer of property. Property distributed to a corporation. So this is when a shareholder distributes property to a corporation. In a taxable transaction, the shareholder's gain is the stock or assets given from the corporation to the shareholder minus the adjusted tax basis in the property. That makes sense, right? Because the stock or assets given by the corporation should also be the fair market value if only property is being distributed or only property is being transferred to the corporation, should be the fair market value of that property. And then minus our adjusted tax basis in the property. So this is what we already own in the property. If the transfer is deferred, the shareholder's tax basis in the stock is dependent on either a realized gain or loss. So the basis in the stock will equal the fair market of the stock minus the gain, or the basis of the stock will equal the fair market of the stock plus the loss. Which transactions can be deferred? This is when we talk about section 351. Shareholders, there are 3 rules. Shareholders must transfer property to a corporation. They can transfer a mix of services, which we will look at later, but right now, transfer property to a corporation. We have to receive stock in exchange for property. We cannot receive just cash or just property in exchange. We must receive stock in order to defer the gain. And then we must control the corporation immediately after that transfer. The rule of thumb is we own 80% or more of the stock. So let's look at transfers that would qualify. If Beth transferred $80,000 worth of land, so that's the property, in exchange for stock, that satisfies rule number 2, which makes up 90% of the corporation. That satisfies rule number 3. Transfers that don't qualify, Beth provides services to the corporation in exchange for $20,000 cash from the corporation. So in the transfer that doesn't qualify, Beth has not given any property at all. She's only provided services, and we have only, as the corporation, given her cash. It does not say how much of the corporation she owns. It doesn't matter. It really, really does not matter because, first of all, she can't own the corporation if we haven't given her stock. So those 2 rules are very closely intertwined. But also, if Beth owned, let's say, 10% of the corporation, then that kind of transfer would not qualify. Okay. When shareholders combine. Basically, shareholders may combine to qualify for a deferral. However, they have to combine in purpose to qualify for this deferral. They can't just combine for any old reason. They have to combine in purpose for qualifying for this deferral. They also, if the shareholder, so also any property, if shareholders combine and some of them give the corporation services and some of them give property, then the property must exceed 10% of the stock received for services. So that's 10% of property must be received 10% of services, right? So in an example, it makes more sense. Jim and Dan work with Betty to qualify for section 351. Betty transfers $40,000 worth of buildings, right? So that's the property. Jim and Dan perform $120,000 worth of services. Betty receives 25% of the company's stock. Jim and Dan receive 75%. So we're looking at that second rule. How much do they own collectively? They own 100% of the company. So we're satisfying that second rule. Do the 3 qualify for section 351? So they do qualify for section 351 because they own more than 80% collectively, right? They also receive stock in exchange for their property. That's perfect. And the property is greater than 10% of services. So that calculation, the $40,000 is the building, the property, and then we're doing that over the services amount. So that gives us 33.33%, which is greater than 10%. So these shareholders will qualify for section 351. Existing shareholders transfer to qualify new shareholders. This one is a little bit more complicated. Existing shareholders must contribute property that has a fair market value of at least 10% of the value of the stock already owned, and that's the stock that they already own in the corporation, to be included in the control test. So this is a stockholder or a shareholder who is already in the corporation, who already owns shares, who is contributing more capital into the corporation in order for a new shareholder to qualify for section 351. So let's look at this what if situation. Jacob agreed to make an additional property contribution to help Al qualify his transfer under 351. Jacob's 75% ownership interest in SCR was valued at $300,000 at the time of Al's transfer. Using the IRS standards for ruling how much property at fair market value must Jacob contribute to SCR to have his ownership of stock in SCR counted in determining if Al qualifies for deferral under 351. Let's just stop there before we look at that second question. We know that Jacob, since he's an existing shareholder, must contribute at least 10% of the value of stock that he already owns. So what is the value of stock that he already owns? That's that $300,000, right? $300,000. All that we need, 300,000. All that we need is 10% of that. What's 10% of 300,000? 30,000. So that is our answer. Jacob must contribute $30,000 worth of property in order to qualify Al for the deferral. Now, this next question wasn't actually in the text, but it was something that I thought of. To be honest, I'm not quite sure that this answer is correct, but it feels right in my heart, right? So let's go with it. Now I want to find how much property must Al transfer in order to qualify under section 351. My thought with this is, okay, well, if Jacob transfers 10% of the value of the stock, and these are joined shareholders, then Al has to put in the other 90%, but he must control 80%. So these were the calculations that I put together to figure that out. We know that 75% of this corporation stock is $300,000. So this is where I did the calculation of $300,000 times divided by 75%. This gives me what 100% of the SCR stock is. Then I took that total 100% of SCR stock and divided it by 20%. The reason why I divided it by 20% was because I know that Al must control 80% of the corporation. So this $400,000, it is how much capital has already been invested in SCR. So then if we want to know what 100% would be once we bring in our new shareholder, this is the calculation to find it. Once we find that 100%, we multiply it by 0.8, which is 80%, to find the amount that Al should contribute. However, Al is coming in with Jacob, and Jacob is contributing $30,000. So we take that $30,000 away from the amount that Al has to contribute, and then that's how we get the $1,570,000. Okay, that was just a bit of fun though. Oh my lord. What is boot? I could not figure out what boot was. Is it cash? Is it property? I genuinely just had no idea. This took me so long to figure out. Historically, boot has been extra cash or property thrown into a deal to sweeten it up. Now we're tax accountants, so do we get a sweet deal? No, we don't. No, we don't. So for purposes of Chapter 8, boot is any cash or property received in addition to shares distributed to the shareholder. Now, we're talking about transfers, right? Boot, technically by definition, is a not like kind property. A not like kind property. What does that mean? That means that the main property that we are distributing are shares, is stock, right? It's not like kind because it is different from stock, which means that it could be cash or property, right? So the second part of this is just an observation that I made while I was going through the what ifs. When boot is not received, the fair market value of assets transferred by the shareholders equal the fair market value of stock plus those liabilities assumed by the corporation. When boot is received, and if there are no liabilities, then we just cross that out and we just say fair market value transferred of assets transferred by the shareholder equals the fair market value of stock. That's a lot like what we were seeing in that second slide, right? That the fair market value minus the tax basis equals the gain, right? But if there's no gain, then the fair market value of assets equals the fair market value of stock. When boot is received, fair market value of assets transferred by the shareholder equals the fair market value of the stock transferred plus the boot, right? Plus the cash or the property. It could be either one. So we will go through some examples, and I'm sure that you will also make that assumption. You know, like I'm not just talking to myself. Who is online like looking for these tax videos? You know, that's what I want to know. Who's just like on YouTube like, you know what? I'm in the mood for a 40-minute tax video. Okay, so me. This is what I will see later on. When no boot is received. When no boot is received, let's look at this example. Ben transferred the following property to Candy Corp. Now, I thought about using Lynch Corp, but I don't think anyone would be buying from them. So Ben transferred the following property to Candy Corp in exchange for 80% of stock in Candy Corp with a fair market value of $75,000. So then we can assume that he falls under section 351. Candy Corp assumes a $15,000 mortgage on the land. Now, something really quick to note is this $90,000 is the fair market value of assets transferred by the shareholder. So let's take that 90,000 and that equals the fair market value of the stock plus the liability that the corporation assumed. So we want to know what gain does Ben realize. Now, this is more of a formula than anything else. Ben realizes $65,000 of gain. And this is how much he realizes, not how much he recognizes. So he realizes $65,000. We take the fair market value of those assets received. Actually, no, the fair market value of the stock. I should have clarified that. The fair market value of the stock plus $15,000 of the mortgage assumed minus the tax basis. That makes sense, right? That's the fair market value minus the tax basis. That's how much gain he realizes when no boot is received. Now we want to know, what is his tax basis in the stock after the exchange? Well, he had a tax basis of $25,000. Now, when no boot is received, we're only going to take out $15,000 of the mortgage, okay? That gives us with a tax basis of $10,000. Ben's basis, what would his basis be if he didn't qualify for Section 351? His basis would just be $75,000, which is the fair market value of the stock. Yep. Okay, when no boot is received, or when boot is received. Now, what is boot? What is boot? Boot is anything additional to the stock that the shareholder is receiving in this exchange. Okay, the shareholder must receive stock in order to defer this exchange. So it's going to be any property, any cash that we look at. So in this example, Ben transferred the following property to Candy Corp in exchange for 80% of stock in Candy Corp with a fair market value of $80,000, and we also received $10,000 cash. This is the boot. What gain does Ben realize? Okay, so when boot is received, this is a more challenging calculation. Okay, so let's move on to this next slide. Oh, don't look. Gain realized calculation. So I guess I haven't done the whole thing. No, I have. Okay, hold on. Okay, so I said that this was the gain realized calculation, but this is actually the gain recognized. It's both, but let's say that it's the gain recognized because that's what this number is, right? Gain realized would be this number. Okay, so we have to take the fair market value, subtract out our tax basis. That's all that we have to do to get the gain realized. Then we have to figure out a separate calculation, which is the boot apportioned. Now remember that we had $10,000 worth of boot, and the boot was just the cash that we received apart from the stock. So we take the fair market value of the assets. We want to find an apportioned value of each of those. The fair market value of the assets, let's use 30,000 for our example right now. 30,000 divided by, all of these added up is 90,000, gives us 33.33%, right? So 33.33% times this 10,000 gives us 3,333. That's the amount of boot that we are apportioning to the building. So the amount of boot that we are apportioning to the building. Now, to realize how much gain we've recognized, that was a weird way of putting that, but bear with me. When we figure out how much gain we've recognized, we take the lesser of these two amounts. We either take the gain realized or the boot apportioned. So you can see that for all of these, the boot apportioned was the lesser. That's all. So we just calculated that gain. We calculated the gain realized and the gain recognized. Now we want to know the stock basis. The stock basis, again, is more of a formula. It's that 25,000 tax basis plus the 10,000 gain recognized that we just calculated minus the $10,000 boot. And that gives us a $25,000 stock basis. Now we want to find if Ben sold his stock for $80,000 today, right, just after this transfer. If he sold his stock for $80,000, what amount of gain would he recognize? He would recognize a $55,000 gain. We're going to take the fair market value of the stock, the $80,000, subtract out the tax basis, and then this is the portion of the realized gain that was deferred. So we already recognized the $10,000 of that $65,000. Okay, we already recognized that $10,000. So the remaining amount of gain that has to be realized is $55,000. So if Ben does decide to sell his stock, again, the fair market value of the stock is $80,000. So it's more than likely that he would sell it for $80,000. Now, we take that fair value of the stock, we subtract out the tax basis, that gives us $55,000. But that makes sense on this level as well, that the gain that we realized was $65,000. We subtracted out the amount that we already recognized. This was basically the boot apportioned, and then that gives us $55,000 as well. So I hope that that's all kind of coming together a little bit more. Liabilities assumed by the corporation. When a shareholder transfers property with a tax avoidance liability. So this liability will be something like the shareholder takes out a $30,000 mortgage on their land that basically cost them, let's say, they had a tax basis in the land of like $10,000. So they take out a $30,000 mortgage and then they go buy a car and then they transfer this property. That is what property transferred with tax avoidance intentions looks like. So the shareholder would recognize the boot, which is the liability, as a gain and realize the fair market value of the property minus the tax basis. Okay. When property does not have tax avoidance purposes, $0 of the gain are recognized since boot is not present. we must recognize the lesser of boot received or gain realized. So let's look at this example. Beth transfers $100,000 of land to Candy Corp, in which she had a basis of $50,000 in exchange for stock. Beth took out a $30,000 mortgage on the land 5 days prior to the transfer to buy a new car. What gain would Beth recognize? Well, Beth took out this $30,000 in order to buy a new car. We can pretty safely say that this has tax avoidance purposes. So we are going to recognize that whole $30,000 as boot and as the gain that we would recognize. Okay. Now, getting into liabilities in excess of basis. Ben transferred the following property to Candy Corp in exchange for 80%, so it qualifies under Section 351 for as far as we're concerned, of stock in Candy Corp with a fair market value of $45,000. So this stock has a fair market value of $45,000. Candy Corp assumes a $50,000 mortgage on the land. So let's stop there for a second. We have a $50,000 mortgage on the land. The tax basis in the land is only $10,000. So let's make note of that right now. What gain does Ben realize? And also, what gain does Ben recognize? And then we want to know his stock basis. Okay, so this is another formula heavy slide. We're going to realize $70,000 gain. We're going to take the fair market value of the stock, $45,000. We're going to add the $50,000. And then we're going to subtract out the tax basis, which we find down here. So that's the fair market value of the stock, and that should make sense, right? Because this is usually what we would say our assets are valued at. So that would usually be what our assets are valued at. However, we also have this mortgage that the corporation is taking on. Now, we as the shareholder recognize that this mortgage is added because the corporation is taking that on for us. We no longer have to pay it. So we're going to take this fair market value of the stock plus this mortgage that we no longer have to pay minus our tax basis. And that's the amount of gain that we realize, okay? Then how much of a gain will Ben recognize? Well, he's going to take this mortgage, since it is in excess of our basis, minus our basis. That's all. Now, if this mortgage was not in excess of our basis, since this qualifies for 351, we would not have to recognize anything. Since the liability is greater than our basis, we will have to recognize the difference as a gain. Now, what's Ben's stock basis? His stock basis is $0. I think this is more of a formula issue. It's $25,000 stock basis, which we got down here, $25,000 stock basis, plus the $25,000 gain recognized that we calculated, minus the mortgage. Equals $0 tax basis. Cash method versus accrual method basically just says that cash method taxpayers don't recognize accounts payable. So if the shareholder uses the cash method for accounting purposes, we realize a gain when liabilities are involved. Remember, realize is not recognize. So we will not record liabilities as of that moment. We calculate that though through fair market value of the stock plus the liabilities minus our tax basis in the property. The shareholder recognizes a gain of $0 since the payable is not recognized by the taxpayer. We know that, right? Accrual means that we either pay later. Accrual means that we recognize prepaid assets. Cash payers would. That's a story for a different day. Accrual means that we recognize that we will pay things later. But cash method taxpayers only recognize those payments when we make them, right? So all that this means is that their stock basis in these assets will remain their basis. That's all that we really need to know. Okay, tax consequences for the corporation. Corporation's basis in the tax property equals our shareholder's tax basis plus the gains recognized by the shareholder. That should be almost intuitive, since the shareholder's tax basis plus the gains recognized by the shareholder would give us a tax basis that would not allow us to be double taxed, right? So if the shareholder has already paid gains taxes on that transfer of property, we don't want to have to pay them a second time, right? So that's all that is. And then our aggregated adjusted tax basis will either be the lesser of the shareholder's adjusted tax basis or the fair market value of stock received by the shareholder in the transfer. Now, their adjusted tax basis, what is this? Their adjusted tax basis will be that tax basis plus the gains or minus the losses. When there is boot involved, we have to do this in a couple of steps. First, we want to allocate the stock and the boot received to each property based on the fair market value. So we saw that in a previous slide. Basically, we found the percentages of land is this much of the whole fair market value. Buildings are this much of the whole fair market value. Inventory is this much of the whole fair market value. And then we apportion our boot and we apportion the stock received. Received. I before E. Hold on. I before E. It's actually right there. So, yeah. Received, right? Allocate the stock received and boot received to each property based on their fair market value. For each property, we need to find the fair market value of the stock. And again, this is the apportioned amount. So we're going to use those percentages, multiply the fair market value of the stock, and then we're going to add the apportioned boot amount as well. This is for each property. So we're going to do this every single time. So for inventory, building, and land. And then we subtract out the tax basis of each property. So that's the tax basis of the land, the tax basis of the building, the tax basis of the inventory. The aggregated basis for when there is boot is the carryover basis, which is just the original tax basis of the property, either plus the gains or minus those built-in losses. Okay, perfect. Depreciable assets transferred. Okay, for this first part, all that we need to see is that the corporation's adjusted tax basis, and again, these are when the assets are depreciable, equals the shareholder's basis, that's the original tax basis, plus the gain recognized. Now, the gain recognized, if we can remember for when there's boot apportioned, is either the realized gain or the boot apportioned. So we did those calculations for each property. We found it's the lesser of either the realized gain or the boot apportioned. So the corporation's adjusted tax basis is the shareholder's basis, the tax basis in that property, plus the gain recognized or boot apportioned. Whichever one we chose when we did that. Remember, it was the lesser of. Now, the corporation carries over the depreciation schedule of the shareholder. And that's just a fact. That's all that we need to know. Next time, we will get into taxable and tax-deferred corporate acquisitions.